Hello, welcome to UC San Diego and the Japan Forum webinar series. I'm Ulrike Schaede. I'm a professor of Japanese business at GPS at UC San Diego, and I should actually turn this on. Allow me to make some introductory remarks. You are at the School of Global Policy and Strategy at UC San Diego. We at GPS offer 7-degree programs, including a Master's of International Affairs that has a Japan specialization. If you'd like to know more about our various programs, please go to gps.ucsd.edu. At GPS, we have a Japan Center called the Japan Forum for Innovation and Technology, JFIT. JFIT wants to connect San Diego, or California for that matter, with Japan, and we offer a variety of programs. If you'd like to know more about JFIT, please go to jfit.ucsd.edu. And please note that if you're interested in past events, past webinars, they are on our website under webinars, and you can watch recordings of previous shows. Before I turn to today's seminar, let me alert you our upcoming sessions in the next coming weeks. Next week, we'll have Nobuo Tanaka, the former executive director of IEA Paris, which is a large international energy association, and Jeffrey Rector, who is a Japan energy specialist, to talk about the post-Fukushima, post-corona energy situation in Japan. This will be followed by a discussion about the societal and economic impact of the Tokyo Olympics, and in particular, their postponement. They should have started on July 23rd. No, they won't. We'll have to wait for a year. And so we'll discuss what that means for people in Tokyo. Thereafter, we'll have the politics of economics, and then we'll go back to business and look at why and how exactly it is so difficult to manage change in large Japanese companies. So please join us if that sounds of interest. All right, and with that, we are at today's topic, and I am tickled pink to have Peter Gourevitch with me. So let me, before I introduce Peter, though, let me tell you what we're talking about. And actually, I'm gonna, Peter, I'm gonna take the spotlight off me so that they can actually see you as I do this. So corporate governance is often discussed in a very particular way, depending on who you ask. You ask an economist, it's about efficiencies. You ask a CPA, they're very interested in the rules and regulations of what companies have to do. But today we want to take a little bit of a different tack. We want to look at the responsibility of the corporation within a country's social contract. We want to take a very broad view of corporate governance, and we want to see what the role of companies is in a given political economy. And so with that, I'll stop my share and make sure that everybody can see you, Peter. Let me introduce Peter Gourevitch to you. Peter Gourevitch is one of these, first of all, he's the founding dean of IRPS. You may remember we have a bunch of alum listening to us, the School of International Relations and Pacific Studies, as it was called in 1987. We were also for a while, Peter, referred to as the PEC Rim School. And your insight at the time was that the Pacific would be the 21st century place of action, and you know that still seems to be true. So you were the founding dean of GPS from 1986 to 1998. You are also a distinguished professor emeritus of political science at the University of California, San Diego. You're one of the best known people in the country in the fields of IR and comparative politics, and an early author on what globalization means for domestic politics. And you have spent your career at very many universities, your PhDs from Harvard. Most of the places you've been to are actually Harvard and UC San Diego, and you have made a great impact on all of us. You've written 11 books at least, by my count, and many, many papers. And I don't think there is a PhD student in political science in this country that hasn't read The Second Image Reversed, which was an early insight how globalization affects domestic politics, and vice versa possibly also, and that we can't look at the two and sort of as if they were separate domains. So today we want to talk about the company, or in fact the political theory of the firm. What is the role of the company in a setting? And that's our definition of corporate governance, really, right? So how do countries structure the rules and regulations or the incentives around companies so that they perform a particular function within the political economy? And so, Peter, Thank you for joining us. And so let me have you talk a little bit about your view on this, and then I'll add a sort of a Japan perspective, because the US and Japan have always been sort of at opposite ends of this, and some people think that's good or bad, but it's just very interesting for us social scientists. It's interesting that there are two countries that have such different systems. And so we'll talk about all of this, and I'll let you start now.
Well, thanks very much, Ulrike. I really appreciate your inviting me to join this. This is a great opportunity because you and I have been discussing this for quite a long time, this topic. And I think you and I both share an interest that we think corporate governance is the bottom of everything. It explains everything. All the inequality, corporate governance is behind it. The social pollution, corporate governance. You're not getting policies that you want to change on better products, corporate governance. The reasons, it all has to do with corporate governance. That anything you look about how countries are differ or do good or better things, is corporate governance behind it. And I first became interested in this topic really from the Japan, America, Europe comparisons, which really drove the creation of the school some bunch of years ago. And when you and I started talking, in those days, there was a tremendous amount of interest in why was Japan doing better and America doing worse and the corporations doing better. As you say, originally it was an issue about efficiency, but people have come to understand that it's really about a whole lot more things than just how well is the product made. And there was a lot of debate about it back in those days about what was responsible for the difference between Japan, the United States, and other countries. Famous people said different things. And I became interested in it because the more I read about it, the more I became convinced that the difference is all the roads lead back to questions of corporate governance. It's how countries have structured the way the firm is run and who controls the firm. The firm is corporate governance, in our view, I think, is the political theory of the firm. It's the distribution of power in the firm, who gets the resources, who gets the money, who gets to make the decisions, and who, at the end of the day, gets the money. And so let me share my slides. I think I've mastered how to do a slideshow on this thing. Let me do it and run quickly for you through this thing. Is it doing it? You are screen sharing, but I don't see it. Is it on there?
It is on there. If you
Okay, great. And now I have to do the slideshow. Okay, great. Okay, let me give a quick summary for you of what the idea is. Basically, back then when we started to work, the issues about how to understand corporate governance systems 30 years ago, the basic idea was people were very obsessed with what's called agency theory, which our students have studied, which is the basic problem was seen as how do we make sure that the managers who run the firm are responsive to the people who presumably own it. And that was the shareholders. So there were two views out there on how to do this. The American and British view was that you have a mass of small shareholders. They pick a board of directors. The board of directors picks the senior managers. The problem there is that the small shareholders are so many and diffuse that they have a whole lot of trouble getting together to pay careful attention to what the board of directors is up to, and to say nothing of paying attention to what the senior managers are up to. The other model, which we find in Germany and to some degree in Japan, although set up quite differently, is instead of many small shareholders, you have a dominant blockholder who is able to play an important role as the means to pay attention to what it is that the board of directors is up to and to interact directly with the senior managers. In Japan, it's not that they have blockholders, but in Japan, you have interlocking directors and cross-shareholding, so that you don't really have the effect of shareholders not able to coordinate them. So in this view, this Anglo-American view, the problem was seen as how do you protect minority shareholders? And so you create this enormous system of minority shareholder protection, information disclosure and audit, oversight board independence, control rules about takeovers and voting procedures, and managerial incentives. Whereas in the controlled shareholder model, you have a few large shareholders, weak minority shareholder protection, no rules on insider trading, weak information reporting standards, weak market for control, and lots of cross-shareholding and pyramid control. Well, this leads to very, very different systems around the world. This is a diagram from the book that Jim Shin and I published some 20 years ago which shows the extraordinary variety on just one indicator, ownership concentration. The United States at that time had very low ownership concentration. It was there in the upper left-hand corner. And then you go all the way to Argentina, Greece, and Chile, which had tremendously high ownership concentration. That's an extraordinary degree of variance. So the prediction that Jim and I had in 2005 was, if you have strong minority shareholder protection, the investor will feel safe from insider exploitation. Internationalization, that is the ability of money to move around the world, will cause investors to look for markets where they have protection and most have strong minority shareholders protection. And that will therefore bring about change, and the block holding system will weaken. Now, to some degree, that has happened. And Ulrike, when I'm finished with this, I'm expecting that you will talk about all the changes that have taken place in Japan. And to some degree, some of this has been happening to attract foreign investment and stuff like that, or the right kind of investment. But what's startling is the extent to which it's not happened. Jim and I have been talking recently. We've been very startled that it has not happened in any way to the degree to which we expected. And so I've written a paper in a volume that Ulrike and I are contributing to look at what's not happened. And now we'd say that that original model about protecting minority shareholders is now in something of crisis. There's been a lot of disillusionment with the shareholder model, glaring inequities and instabilities. The tremendous economic crisis of 2008, for example, even long before the current crisis, which is caused by something else, the COVID-19 crisis. But the huge crisis of 2008 showed tremendous instability in what was supposed to be a great system, the United States. The banks had to be rescued. Things were colossally being mismanaged, so exposed tremendous weaknesses. In addition, tremendous inequalities in income, huge shift of return to the owners of capital, huge increase in managerial income. It's hard to say it's been run on behalf of the shareholders. It's been run on behalf of a certain block of shareholders who benefited to the expense of the others. And there have been tremendous inequalities that have become exposed, huge, as many of you know, the ratio of income between the top paid and the low paid inside the firm is extraordinary these days. It's 400 or 500 to 1, as opposed to the old days, it was 20 to 1. So there's a lot of controversy over this. And we now have discussions about a shareholder versus stakeholder model. The idea that the firm now exists only to benefit the shareholder model. There have been questions about that raised for many years. Those questions have risen greatly. The COVID crisis has accentuated that, as we've seen the importance of the people who drive the ambulances, who sweep the floors in the hospital, and we think how terribly badly they're paid. The recent statement last year by the Conference Board in the United States walked away quite. There's a famous Milton Friedman quote of 50 years ago, said that the firm existed in the interests of the shareholder. And that was the 50-year dominant ideology. Now the Conference Board says, no, we're not going to do that. But that's a lot of controversy about whether they really mean it. Is it just cheap talk, or do they really mean it? So there have been big changes in markets since that time. What Jim and I have been talking and working a lot about is we've been looking at tremendous growth of tremendous concentration of money in institutional investors of several different kinds, state-controlled funds, sovereign wealth funds, private equity firms, shareholder activist funds, and new types of block holders, changing ownership structures, which have been creating a very, very big shift in what's going on. This diagram, which you have on your screen now, it's hard for you to read. I don't have time to talk about it, but what it shows is that new categories have come out. Within each of these categories is a huge concentration of ownership within just a few firms in each category. And the consequence of that is being that the ideas of 20 years ago are not very effective. It's not clear what's going to take place. We might talk about that. We need to make managers accountable. We need to find new ways and new institutional structures, new ways of solving the agency problem, other than just the traditional minority shareholder protection. because less and less of the money is actually in such structures, and there's all kinds of people who are being left out of it. So we could talk about some ideas about how to do that, and those are my thoughts, and I will now stop sharing and turn it over to you for your ideas, Ulrike.
Yeah, thank you, Peter. Can you click the stop share button?
Yeah, I have to get.
Yeah, there you go.
Okay, great.
Oops.
Are we back?
No, not quite yet.
I just have to find my cursor. I found my cursor.
I can do it.
I got it.
I got it. Okay. All right, very good. So, so thank you, Peter. So there was a lot packed into this, and the big thing that I got from your slides was there's a particular American system with a particular U.S. discourse on what we want to accomplish, and it did indeed sort of. It was for many years rested on this Milton Friedman idea that the social responsibility of the firm is to optimize profit. Now, that is actually a sentence that's taken out of a longer paragraph that then goes on saying, and then once the firm has earned the profit, it can do some good stuff with it, like paying people. That got kind of lost over time. But that was the basic idea. The other thing that the US, that has come to characterize the United States, is agency theory, as you said. And agency theory starts with the idea that there is an insurmountable conflict of interest between the managers of the firm and the shareholders. And what's interesting about Japan is that Japan, not only historically, but even with the ongoing reforms, is actually saying, well, wait a minute, why do you think that way? Is that really true? What if everybody wants the firm to be successful and prosperous in the medium to long run, right? And if we start from that, what happens to the governance system? So let me share my screen on what's happening in Japan, and then I want to sort of hear your reactions to what I just said. So I'm going to do this. I have to go. So so people that are the regulars already know that I have a new book out, and I have a chapter on corporate governance in that book. Why? Because there have been a lot of changes, and so the business reinvention of Japan is also around who monitors management and who holds management accountable. So let me give you some background, and I'm going to do this fairly fast. If you're interested in the details of this, let me know, and I'll send you some information on this. So the post-war Japan that we studied in the 80s, as you just mentioned, started with the idea that not that shareholders had to be sort of protected from abusive managers, but that that companies were valuable and markets were unpredictable, and so companies had to be protected from the markets. And that was because in a system with lifetime employment and suppliers and so on, the suppliers, the buyers, the communities, the employees were the assets. And the assets were considered more important than the shareholders. And the shareholders were other companies mostly, and they had the same thing going. So everybody kind of let companies do what they wanted to do in a way, and then there was a main bank that would help in times of crisis. The CEOs were internal managers that had made their way all the way up the hierarchy, literally from the bagger at the supermarket to the CEO of the supermarket. And so the senior executives were considered to actually be very interested in the longevity of the firm, and that was institutionalized by way of having a very low executive pay, but a very high pension reward for them. So their pay was sort of back-ended. So they had to the extent they were incentivized to do anything to the company, it would have been that they were too risk averse. So that worked okay for a while, but then a bunch of things happened that changed the goals, right? And so before I go there, let me just show you what happened to the shareholder structure, which is actually an expression of this. So these are data on the average shareholder composition of a listed Japanese company, and we start in 1986 at the top. And what you see up there, if you do the math, some 70% of a listed Japanese firm's shares on average, was owned by either a bank or a financial institution or another company. And the red on the side is the foreign shareholders, and they were tiny. But if you fast forward and go at the bottom, it's 2018. And what you see is basically that these two red boxes there are now more than 50%. So the banks have shrunk. They're no longer really in the game. The individuals are often actually sort of rich block holders, like Masayoshi Son owning 30% of SoftBank, or Mikitani-san owning Rakuten. But what we're interested in here is these reddish things, and there are two. One is the foreign investors, so this would be Wall Street managed funds, and the other, and the lighter pinkish ones, are so-called trust banks. And these are Japan's institutional investors. They manage pension funds and other corporate assets, maybe also private assets. And so they are institutions. And one of the big questions in Japan right now is, what do these institutional owners do? All right, so fast forward 2020, what are the goals of corporate governance in Japan today? And a couple of things have happened. One is globalization. So a lot of Japanese companies no longer actually have domestic supplier networks or even domestic employees. They are global players. Toyota makes 60% of its car outside Japan, right? The second is the Tokyo whales. Those are two huge investors, namely the JPIF, the pension fund, and the Bank of Japan, which has done some quantitative easing by way of stock purchases. And the whales are basically index investors, which is something, Peter, that I want to ask you about in a moment. And then, of course, there are the foreign investors, which we know are basically interested in higher returns on investment, as are, by the way, the institutions and the global players, right? And the banks, on the other hand, are out after deregulation and the collapse of the main bank system, right? And so we have this new need where the companies don't want to be within global fetters anymore. The government wants higher ROE, and the foreigners want the same thing. And so we're not going to talk in much detail about what the reforms are. Let me just note for the record that there have been tremendous reforms. In particular, in 2015, there was a triple reform package. A lot of this is about board membership and outside directors. But there's also now a stewardship code, something that the United States doesn't have, but many other countries do, that makes asset managers, so these would be these trust banks or institutional investors, responsible for representing asset owner interests. So, and so what's interesting for me in all of this is that two things. One, Japan has basically changed. There are new owners, there are new needs, there are new goals. And at the same time, the Japan trajectory is still very different from the US, because it's still not really about profits as much. Profits are important, but they're not as important as employment. So let me just give you one data point. Even after 5 months of COVID, the Japanese unemployment rate is 2%. It would come at a huge reputational cost for a large Japanese company to lay off people. And so, so they don't. And they can do that because they have a lot of current assets, cash, a stash of cash. But the new Japan is also the story where the activist investors from Wall Street are now coming in to Tokyo and say, well, in the name of progress, these Japanese companies should become more efficient, and so they should buy back their stocks, up the stock price, make us rich so that we can go home. So there's this whole new situation where some of the American features are coming to Tokyo. And so we want to talk a little bit more about, so what is the purpose then? So the Japanese purpose with corporate governance very clearly stipulated at the beginning of the governance code, which is the purpose of corporate governance is to ensure the long-term value creation by companies. And that is sort of the idea behind the role of the company in the Japanese economy. So what I've always been puzzled by, Peter, and it goes through your entire work, what is the role of the company in the United States today? I mean, what in our social contract in the US, what is the idea that companies should accomplish? And what has gone wrong with that idea?
I find it very interesting. I'd like to challenge your asking that question, to tell you the truth. I'd like to throw it back. I'm sort of a little bit puzzled by, I'm not sure that I understand how everything works by looking for a statement about the code. I mean, for example, the conference board has now announced that it no longer believes in the primacy of the shareholder, and it's announced that it believes in the stakeholder. It did that, and there was a chorus of discussion and skepticism about whether those words are to be taken, what value do we give to those words? And so I don't know how to think about those words. I mean, I can see that the values given, I don't know how to think about those values. I don't know what I'm going to learn. I don't know where I would go. The United States is, 300 million people and so many different companies. And you're asking me what's the core value of the firm in the United States? I frankly don't find that a very meaningful question. Who could specify what's the core value of the firm in the United States? There are too many different kinds of firms. There's there's Facebook, and there's AT&T, and there's auto companies, and there's so many different kinds doing so many different things. And I mean, I think that's I thought that diagram that you put up there was a fascinating diagram. And the question I wanted to know was, when I saw it, I wanted to know was, what's the motive of each type of shareholder? You showed me who owned it.
Right.
The changing composition. So I think that's a great way to think. What does the changing composition mean for the impact of that on the behavior of Japan? Because I want to know, what does each of those types of shareholders want? And you said, if this is if I remember, there was in the east, on the right side of that diagram, I think they were pink, darker red and pink. And you kind of lumped them together, whereas to me, they were very different. The pink ones were the trust banks, and you said that was like institutional investors. But the next one over were foreign investors, who seem very different to me. I don't know who they are. Foreign just means they're foreign, but who are they?
So that's a great question.
Foreign could be sovereign wealth funds, or foreign could be CalPERS, or foreign could be American institutional investors, or European ones, or British ones, or they could be, there are so many different kinds of foreign investors with different motives. And so I would like to know a whole lot more about what are the goals of the different kinds of investors in the Japanese system, and what were they before? How are they different from today? Because when you describe the system from before, I would say that it wasn't a value system that meant that they cared about each other so much. The firm, it wasn't that they believed in the firm. It was the entire production strategy pioneered by Toyota. The entire production strategy was based upon getting a kind of efficiency that came from an incredibly intense interdependence of all the different pieces in this production system. I would share my technology with you to make so that you could produce the right kind of brakes with me, but I wanted to be gosh darn sure that you weren't going to betray me. And the way I made sure of that was I owned a piece of you and you owned a piece of me. So you created remember lean production, you create efficiencies like just in time, the ability to stop the assembly line, sharing technology, no accumulation of inventory. But lean production creates a very high degree of vulnerability. And so the way you buffered that vulnerability by creating great interdependence. You had great interdependence, so you made sure that they couldn't betray each other. So the critical thing to me is what you said earlier is that no longer very important in their productive strategy. So if it's not important in their productive strategy, then that interdependence is less important, and so they can unwind it. But I'd like to know what is these great big gigantic Japanese companies, I don't know remotely enough about Japan to know what their production strategy is and how they handle overseas supply and putting it all together. The fact that it's overseas doesn't mean much. You can still be interdependent with your overseas supplying.
Yeah, so
Anyway, that's my opinion. You asked me a question, and being an old retired professor, I gave you a long-winded answer. It took a lot of time. Sorry, your turn.
and you gave me 20 questions back. So let me just say something about these red chunks there that are now half of the ownership. One of the most interesting things to me in the foreign ownership is that a lot of that is Japanese money that is routed through investment firms in Wall Street. Why?
Yeah. Why?
Because you can be more pushy on returns if you're incognito, right? And so, and you know, part of it may be just because they're better at investment, part of it may be a portfolio investment, part of it may be an exchange rate game, but a lot of that red stuff is actually what's labeled foreign. It's things like State Street, and you know, you're a big investor that you like to talk about, that we'll talk about in a moment.
Yeah.
And a lot of Japanese money is floating into that, right? The trust bank, so this pinkish thing, that is a very interesting species that I've actually done some research on. And so a lot of this is sort of corporate pensions and pension holdings, and so the mutual funds to a lesser extent. So these are the sort of Japanese pooled, you know, and
so they're like Merrill Lynch, Fidelity. They're the Japanese equivalent. Yeah. Okay. Yeah.
And so they are interesting in the sense that a lot of people in Japan think that they are these indexed ETFs, that a lot of this is actually this whale money, that they don't do much. So I've actually done some research on their investment strategies. And if anything, you know, if you think about what owners want as exit, voice, and loyalty, right? Then that, which is of course the famous theory where we have three options. We can either be loyal to whatever's happening, which is the old Japan thing, right? So the cross shareholders were loyal shareholders that would say, no matter what happens, Peter, I've got your back. And if a hostile takeover comes, I would definitely not share my stake. So I'm a loyal, quiet sort of one. The new type of shareholdings are either voiced, so they're urusai, as the Japanese say, so they get on your nerves. They're like activist shareholders, and they say something, they go to any meeting, and they demand, or they exit. And what really is concerning Japanese CEOs today is the exit, because exits depress the stock price. That invites the vultures, you know, the activist shareholders, the hedge funds, that there are not a lot of green pastures for investors right now. Japan is really tasty. So these activist shareholders like to play in Japan right now. And that is the concern, that there would be a conglomerate discount and so forth and so on. So the Japanese CEOs are quite concerned about those pink and red boxes, because they are assumed to be not loyal. They may be helpful, they may be constructive, they may be nice activist investors, but they might also just be there to put themselves on the board, demand a stock buyback and a dividend payout, collect the money, and disappear. And so one of the things that I'm interested in right now is the protective mechanisms that Japan is trying to build into the system to make it more difficult to play those short-term financial engineering games, and that would be a whole another meeting. But that's something that probably is the least attractive about Wall Street right now. Right, and you're studying these big.
Which is what? What's the least attractive about Wall Street?
These short-term financial engineers that take a position. It's more like extortion. It's not governance. It's extortion, right? They go on the board. They say, hey, buy back some stock. When the stock price goes up, they disappear. And so talk a little bit more about the big investor place and Wall Street, because I think then we can come back to Japan.
Well, I think that's a tremendously interesting topic, Ulrike. I mean, I think the institutional investors How do they behave? And we don't know enough about it. There's, what I've been reading through, and I thought conflicting opinions. The research does not have a uniform opinion about, are they active or passive? They're growing in number. They're holding a greater and greater percentage of equity positions in publicly traded companies. Of course, privately traded companies are a different story. As one of the comments in our chat, somebody made a comment about private versus publicly traded companies. Privately traded companies can do whatever they want, but in publicly traded companies, where you could buy shares, what is the question? Well, what is the impact of the institutional investors on them? Do the institutional investors play a role in management? Do they care? And one of the interesting things about the reforms in the U.S. after the great financial crash was, in Dodd-Frank, one of the rules was that the institutional investors had to divulge how they voted their proxies. They used to not do it. They used to not have. They felt, no, I don't have to tell you, and so they would vote with management. In other words, if you have passive investing, that means that do they, as you say, is an exit, voice, and loyalty? Do they have an incentive to say anything? And so some of the experts are arguing that the system is screwed up because they don't have an incentive to say anything, and they just are quiet. They sit there. So the growth of institutional investors to some people is effectively a way of increasing the autonomy, the classic problem of the autonomy of the managers and the lack of any serious monitoring of their behavior. Other people say,
what the Stewardship Code is about, right? So Japan, so the U.S. is one of the few countries that has not codified this, although the industry is doing this voluntarily now. In Japan, the Stewardship Code is following the UK example. Is basically a rule that says that, and it's not a rule, it's a sort of soft law, right? So, but it's nudging and shaming, so you have to basically do it. And sign up for it. And what you sign up for if you are a trust bank in Japan is that you will disclose how you vote on every single item the agenda and what you're doing and how you interact.
Right.
And so you are now forced to sort of be an active representative of asset owner interests. And what that means is, and the reason why Japan was so excited about the Stewardship Code when the British came up with that idea is that it allows these trust banks, or it actually forces these trust banks to build the talent and the capacity to actually do due diligence on these companies and vote and make up their own mind how they want to vote. And it is widely seen that as a protective measure against short-term financial engineering. That is to say, if a hedge fund comes in and it's too transparent what they want to do, then presumably the trust banks, as representing my savings, say, or my mutual fund, would go in and say, no, that's not good, or that's very good. Right. So we don't know which way that goes, but we want these.
I agree with you. I think these are wonderful things. I think the British are way ahead of the Americans. They're much superior. Some of these things are in there. Some of these obligations are written in. They're developing. I'm all in favor of that. I think we should do more of that. But I just don't know how effective it's being. I mean, to what extent these codes are being used and management is being held to effect by these boards and saying, wake up to the environment side, wake up to the impact on gender inequality or pay and treatment. I don't know. I think that is kind of the big questions of the future in this whole discussion about stakeholders is, what are these codes? And I think that's one way to go. The codes that are being done, these responsibility codes. I mean, one of the appalling things we're talking about the United States is it's hardly discussed at all, even in the last election. The only candidate I noticed who brought up any issue at all about corporate governance, Elizabeth Warren, mentioned it. I don't know if she mentioned the German example of worker participation in corporate governance as a good thing. And, people, oh my God, putting workers on the corporate board, which Germany's been doing for how many decades, and quite well, thank you. So without flaming red flag revolution or anything at all. But I think so. I think that this kind of code that you're talking about is an excellent way to proceed. Another kind of thing, another kind of thing is, I think, experimenting institutionally with what structures. For example, the sovereign wealth fund. Do you want to talk about that, or for what the sovereign wealth funds, which are huge all over the world and poorly understood, and who manages them? The countries all over the world have these gigantic funds. And whose interests are they being run? Who's paying attention to them? What to do with them?
So we have these two things, right? So one is we can regulate, or we can set up these systems and codes and the stewardship and the corporate governance code. You know, I've always thought that if somebody wants to cheat or be just a bad CEO, then they can, you know, they'll do that no matter what the system that we design, because they will find a way around it. They put people on the board that are yes-sayers. They hide some stash. They do the Enron game, whatever. And so we shouldn't really concern ourselves maybe with those guys, because they're actually in the minority. What we want to talk about is, how can we build structures for the main group of companies that actually want to do right, but they're picking up cues from society, right? So what's important today? What would be costly to do? How can I gain? Right? So Walmart announced a couple of weeks ago that they want to have some workers on the board or something, or they want to experiment with that. Basically, a similar thing you was just talking about. And so what would be structures that we could have in the United States, or how do we want to think about these structures that would make for a better system? Or what would have to happen that the U.S. kind of expresses this towards companies?
Well, I think that these I think kind of stakeholder advisory boards would be an interesting way to go. I think more of what you were talking about. I mean, I like the British these codes, and with Japan having these codes for the banks. I think that's a great idea, but you can go farther institutionalizing it. For example, take CalPERS, which is the California pension fund for public employees. That has a structure of representation of some of the investors, some of the employees, the government, the governor, the legislature. Why not have multi-dimensional representation of advisory boards? I mean, you understand, in Germany, I believe there are two boards in a two levels of a firm board, and you could experiment with that and have another board which has an ability to meet regularly, ask questions. You have to give it information. You have to get its feedback on values, goals, thinking that, I mean, modern society, I think, is like that. You need more systems representation. I think that might be one way to do this.
And so Hiroki actually asks, how is that different from unions?
Well, unions are only one of the stakeholders.
Right.
I mean, I do think that there's a lot of evidence that I'm always amazed when I see economists in newspaper, various people, Larry Summers, who I don't regard as one of the great left-wingers of our time, is very centrist, writing articles in the paper saying the decline of trade unions in the United States is one of the major reasons we have severe income inequality. I'm not used to him, there have been people saying things like that for many years. He has traditionally not been one of them. For him not to say that, I think that's quite interesting. But unions aren't the only stakeholders. I mean, that's in a way, I'm in favor of union representation on boards, but I'm in favor of other groups, the local community, the city, there are many other groups that deserve representation and voice.
So you're proposing this like sort of multi-voice idea, right?
Yes.
And so what is the purpose of that? I mean, is it that we want to have greater transparency and accountability, or is it that CEOs, when they make decisions, don't only think of the stock price?
Well, the second of those. I wanted to think when you talk about the shareholder codes, my mind has trouble with a code without some sort of a structure to back it up. I wanted to give it a little meat and potatoes and support. Yes, I'm in favor of codes, but I'm in favor of teaching a child codes and people codes, but I'm also in favor of having courts and punishments. They reinforce each other. And and I think the idea that if you have to get up in front of a bunch of people and explain what you're doing, and you're obligated to do that, even if they can't punish you formally, your obligation to get up and explain to them, and their ability to yell at you, why are you closing that factory? Why don't you have childcare in your thing? Why aren't you supporting a better healthcare system? How can you have a ratio of paying people, all these things? How can you ignore the environment? I mean, obligations, I think Japan does better in this respect. My sense of, Japan.
Really the evil of the stock price. I mean, so this was the thing in Japan, right? So they had this rule of 8% ROE, and then they realized that companies were trying to meet this by cutting R&D and cutting wages, and that they're, oh no, this is not okay. So they actually kind of toned down this whole profit thing and said, no, what's more important is the long-term, sort of longevity of the company, and society believes that, right? So in Japan, if you didn't, I mean, not that it hasn't been the case that in the past they had pollution issues and scandals, that happens in the best of families. But if you look at the majority of Japanese companies, they try not to be in the news with anything that would be detrimental to society in any way, shape, or form. And so, and that's more important than the stock price, right? But in the United States, if you're a CEO and somebody comes to you and says, hey, you closed this company in Detroit or the supplier and wherever, and that's bad for the community, then you would say, yes, but we were forced by the stock price, because, or by the pressure to meet security analysts' expectations for the quarter, which is a whole another interesting story, right? This is all about meeting certain profit expectations. The profit expectations always trump the community expectations, right? Because at the end of the day, we have, I don't know why that is, you're the political scientist, is that because we have
but Ulrike, you're asking me, I don't know. Okay, you have to explain to me the nature of your question. Are you articulating a code and a social moral code that needs to be changed? In other words, when you say in Japan, oh, they can't do that because there would be an outrage. Right. You have to explain to me, what is the sanction against them for doing it, and how is it carried out?
People would think this is a bad company. I don't want to work there. I don't want to buy their product. It's basically shaming.
No, but the effect would be that they would stop buying the product and stop working there.
Yeah.
Okay. And so that means that you have to change the code. You have to change the moral code.
Yeah, well, the moral code, the norms around what is a good CEO.
But I mean, you're also telling me, you're also saying that older system isn't working because people don't want to work for firms like that anymore.
So that's an interesting story, right? So, so part of what's changing right now in the employment system is that people don't want to be working for an old style, sort of very in a highly bureaucratic, hierarchical place where everybody is promoted in lockstep, and you can't actually be on the fast track and get some specialized skills. And lots of very smart people say, I don't want that. And so there are companies out there that are, in Japan, they're saying, okay, we're going to do this differently. You can come to us and we'll have a very different work setting for you. And we understand that labor mobility will go up. But that's very different from laying people off, right? So that's actually currently the employment debate in Japan, when, Akio Toyoda is saying, well, I cannot just let the talent have it their way, and then I give lifetime employment to everybody else. So we have to find a new employment system. We have to make sure that the employer has rights just as much as the employee. And so how do we change the system? But fundamentally, I mean, we're talking about trade-offs here. Societies make trade-offs, right? And you can't have it all. So, and I think that the United States trade-off has always been for more economic growth, for higher stock prices, and our entire system is sort of geared towards our pensions, our salaries, our savings. And so we as a society make certain trade-offs that then as a result reward certain behavior on the part of CEOs. And
yeah, no, I agree with that. I tend to focus, I'm a political scientist, I tend to focus on what are the laws that we pass that encourage that to happen. There are a whole lot of laws, regulations, and things that allow it to happen. It used to be that, brokerage houses and law firms were partnerships, and then they were allowed to become joint ownership. And so that suddenly changed an obligation. I mean, there was a law that changed that allowed that to happen.
Yeah, can we talk more about what went wrong on Wall Street? I mean, so Goldman Sachs used to be, I'm kind of old enough to remember this actually, used to be a highly celebrated, wonderful,
they changed the rules. They changed the rules to allow the greedy people to drive out the ones who believed in commitment and obligation. They had all the moral things that you're talking about. How did it change? It changed because there were people who thought, I can make more money if we change it. Let's change it. And they defeated the other guys.
And so that they stopped being a partnership.
It stopped being a partnership. That was a rules change.
And again, it was because a bunch of people wanted to make more money at the expense of the many.
But that was A defeating B. In other words, it's not that there weren't people who didn't want to do that. There were people who didn't want to do that. They were defeated.
Mm-hmm, mm-hmm.
It's like the polls, there's now, it's not that America wants to change the abortion laws. There's a bunch of people who want to change the abortion ruling. They're able to put people on the Supreme Court. There's a lot of people who don't want that. So it's A defeats B. It's not a change in the moral feeling. It's A's beating B.
So the millennials, that we're using them for so many things that they're going to become sort of this jack of all trades. But the millennials that we know from GPS in our classes are indeed different, right? So and some of it is expressed in they don't want to drive us like, or actually the Gen Zers are, better still, they don't want to own a car, they want to have a driver's license, so forth and so on. And they are talking a lot about the environment and CSR, and you have taught an entire course on CSR. And so how do we want to think about that? Is that a movement? Is that a new incentive? Is that a new trade-off? I mean, do the millennials want us to make different trade-offs? Is that
the millennials want us to make different trade-offs. Well, those millennials, don't forget, it's a big place. There are lots of people who aren't like that. Around here, there's a lot of people like this. Is California. This is Southern California on the coast, and so there's a lot of people who are like that. We at our university, our students are mask wearers who maintain social distance. They're those kinds of people who believe in what the scientists say about COVID. There are lots of people out there who don't believe that. So let's not say all millennials are like that, but those are value changes.
So what has to happen in the United States? I mean, obviously we're in a bad space, and Japan is, we can talk a little bit more about Japan in terms of, wow, they're opening up, and so the $1 million, $1 trillion question for Japan is, can you open up the system and allow global finance to come in, as Japan has, and protect against this detrimental short-term engineering that only serves a few rich people and eventually means that the company does not have the resources to pay people well. Right. Can you do a half sort of baked things and
I think so.
Or is Japan now doing?
Look, I think so. I'm not one of those. Look, I'm not an economist. I'm not one of those who believes that the health of a country is measured by how high its stock market goes. I don't believe it is. I believe all that financially. I'm very skeptical. You know, I used to argue with our colleagues over and over again. I remember having these arguments 15 years ago. They would say, "Oh, this." I was a believer in the late Paul Volcker. I don't. Why do we need all this financial innovation? I believe that banks are there to serve everybody else, not themselves. Banks are there to provide financing so that people can do things. What do we need all this? I mean, yes, they perform an important service, and I very think they should get paid a reasonable amount of money. But all this financial innovation, I don't understand these derivatives that were invented, these great financial things, and they went crash. They weren't very well tested. So I don't think that's a great thing. I don't think that was a contribution to the economy at all. But I remember arguing with our colleagues, Ulrike. I kept saying, why are we doing this? Oh, because it's creating efficiency. What kind of efficiency? Financial innovation is creating more efficiency. Yeah, but to what end? What do we know about it? To what end is that efficiency being done? Oh, no, we have to have more. And these were from friends of ours who were liberals. And I was very skeptical. No, I think Japan could do very well without foolhardy innovation. You could put a limit on it. There are costs to it, and so you should put a limit on it.
So the stock market still, I don't know whether it's because of the bubble economy, but so one of the themes actually that I touch on in my book is that the stock market in Japan is still not very important. It is not the most important thing, and nor is economic growth. So this is one of the more, another interesting aspect. So economic growth in Japan, of course, has been sluggish for 20 years, and American observers are up in arms. You have to get productivity up, you have to get efficiency up, you have to do this. You need economic growth, and many in Japan are saying, why? What for? We're fine. I mean, of course, everybody likes economic growth. It's a measure. It's a boast. It's a competition. It's oh, we grew so much, we're great. And so there's a mindset that we all have. But fundamentally, we could look at per capita economic growth, where Japan is doing quite well because it's a shrinking society. But we could also look at not economic growth, but economic wealth. How affluent is a society? What is this? What is the repair of the streets and the buildings and the the infrastructure? What is the safety? What is the crime situation? So we could actually look at what makes people happy in very many different ways. And the US way of looking at it is stock price driven is a very interesting one. And Japan just doesn't share that.
Well, I don't either. I don't share it either.
All right, Peter. So one final thought. Let me ask you this one question. So there are all these index funds out there in Tokyo because the government owns so much of the stock market, right? So the Tokyo whale is this quantitative easing outcome that the Bank of Japan is a major shareholder in a large number of large companies, and it's all indexed because it's the government doing this, right, as a quantitative easing measure. This may happen in the United States pretty soon, that we'll have to resort to pumping money into the economy by way of the stock market. What do you think about that? And so there are calls that the Bank of Japan should pick winners and not index this across the entire stock market, but really actually play an active role in corporate governance. Would you agree?
I don't agree. I don't think it should be active. I think passive is probably a good idea for a while. I mean, it should only do it if there's a good, what's the motive? In other words, do we know, are there good ideas out there about things that are not taking place? You just described, I think you answered your question. You described a country in pretty good shape in a whole lot of ways that is not desperate. Well, so why should the government, it's got all this investment, what does it want to do with its activism? Is there something it needs to do? If it doesn't, then you just be a passive investor. It should only become an active investor if it had a real substantive need. And the other thing it could do, it could take its holding and divide it into 5 different funds, give it 5 different structures of the kind we were talking about earlier, and see what happens with them. And it could also wait and then gradually sell them off slowly over a great period of time. But I wouldn't become an active investor in them unless I had a purpose that was a reasonable purpose.
I think that is a very, you say that so easily. It's a very
Well,
deep insight. So
and,
if the
and,
government
I,
gets
and
elected, they have to extend.
I have no, I'm sort of on moderate leftist. I have no, I have no aversion to the idea of government ownership. That in and of itself could be good, it could be bad. I'm not a great fan of the private sector either. I think there are a lot of terrific private companies and some terrible private companies. So
So we
private,
need
public, it all depends. It all depends.
we need a strategy. So thank you very much, Peter. Time is up.
Thank
This
you,
is
Ulrike. It was a lot of
remind
fun.
everybody you should please come back next week to join me with Mogo Tanaka, who is a most interesting fellow, and Jeffrey Rector, one of our alums, and in fact, alum of the year this year of GPS. And we're going to talk about post-Fukushima energy policies in Japan, and they are a mess, is all I can tell you so far. So see you later. Take good care, stay healthy, and goodbye.
Thanks, Ulrike. All right.
Thank you.